All right, just a word in on the Nifty before I go across to Sandeep Bharadwaj, who's with us right now. 5302, holding on to 53 odd 100 sort of levels. All right, Sandeep, I believe, is with us now. Chief at Tar Capital. Sandeep, good morning. Great having you with us. Prashant here. What's your sense now, Sandeep? Month of July, any different than what we've seen in the month of June or the last so many months now? And what's the call? Are you because you've been kind of slightly bearish for some time, calling for a fall. We got a 10-12% cut, and the market popped right back.
Morning, Prashant. Morning, Ira. Yes, Prashant, we were calling for markets to head lower, and surprisingly enough, Nifty has been very resilient lately. And I think India is the best performing market right now in the world with near its 52-week highs, and rest of the market are edging towards their 52-week lows. So this kind of outperformance remains to be seen, how long it can last. And because we've got headwinds in our domestic economy, today we have the EGOM meeting deciding about the fuel price hike, and I think that will lead to higher inflation, and we believe that the double-digit inflation is here to stay till the end of the year. And we also believe that RBI has surprisingly been behind the curve, and I think it's got a long way to catch up in terms of the CRR hike. Interest rates in our country haven't moved up for the last more than 1 year, and we expect interest rates to head higher from these levels. So these are the major concerns that we think are in our domestic economy, but markets seem to be ignoring this. But if you were to just take a pause and look outside the country, what's happening, if you take a look at the US economy, the data coming out is suggesting that they are heading towards a double-dip recession. It seems to be quite inevitable. The housing data and the employment data suggests that. We saw very clearly that when the government incentives were taken out from the housing market, there's a 33% drop in new home sales. Now, with Europe, I think the whole Eurozone is heading towards a deflation. And the biggest concern now is the next week, ECB has given a $450 billion repo to the European banks, and that is coming towards maturity after 1 year. And 2/3 of that loan has been given to South European banks. And yesterday too, again, the Greek Prime Minister mentioned that they will go in for restructuring of the Greek banks. That's a big concern. And China, I mean, you know, with the renminbi appreciation, they're allowing the ban to increase by about 1%, and the whole world going gaga over it. I think it's a bit delusional because, you know, if you take at the intraday moves of euro, it's about 1.5%. Rupee trades at about 1% range. Korean won trades at about 3% range. So for them to go and let won appreciate by 1%, it's going to do no good to anybody, or it's not going to make any difference. And you know, the timing may be a bit immaculate in terms of the G20 meeting just before that they have announced, but the decision has been driven primarily because of their home problems. If you look at it, the factory gate inflation in China is about 7%. Food inflation is similar to that to India, very high inflation. And thirdly, the labor unrest because of the lower salary levels. Now again, it's salary levels of the factory people have been increased by almost 100% at the Honda factory. First time in the history of communist China, we've seen that almost a group of 300 workers clash with police. So they have no choice but to let the yuan appreciate, get the inflation down to a certain extent, and get the subsidies out of the system, because the Chinese government pays about $60 billion just to maintain the yuan peg to the dollar, because the dollar investments don't yield any returns, and they have to, because of the interest rate gap between the US and the Chinese government has to fill in the gap. So looking at the global factors, India is still standing tall, but I'm not a big fan of this decoupling theory. I think it's a bit delusional. And it remains to be seen as and when Indian markets play a catch-up on the downside.
Okay, but what's the downside, Sandeep? You know, if you believe the market is a sum total aggregate of all opinions, of all that everybody is doing and thinking, you know, the market is telling you that news might be bad, the market doesn't want to sell off. Look at what happened in the month of June to most European indices. So you could map DAX to what the Nifty was doing, and you probably would get an absolute great correlation. Things in Europe haven't worsened or improved. There is a lot of talk. Probably they've swung back into action, stress tests and banks there. The point is that why not just go with the market, which is telling you that, well, you know, it doesn't really want to sell out despite all that you stated. You know, a lot of bad news is there. So why not just go with that?
Prashant, we are positioned very defensively as you know, since January, and that defensive portfolio itself has yielded very good results. If you look at your long FMCG and pharma space, and those two sectors have outperformed the Nifty. So in terms of that, it's not that we are completely short the market. So it's a very balanced portfolio, but with a short bias. And we will not change the view. I agree with you that the market is not going down, but it's not going up either. These kind of highs were reached in October 2009. So for the last 8 months, we haven't seen higher levels or higher levels being sustained. So how can we go long? Because market,
you got a short bias, but you're not completely short on the market. Okay, all right, fair enough.
Sandeep, morning. Ira joining in as well. I'm going to pick on some of the macro factors that you talked about a little bit earlier. The fact that perhaps in the second half of the year, the risk of interest rate hikes is very much there, and it's being underplayed right now. You know, I've been asking a lot of people that question, and most people tend to disagree with me and say that no, inflation is going to work itself out. You know, there'll be capacity additions. That from the supply side will help ease pressures on demand side inflation. But would you agree that that is still one of the risk factors, and the RBI, if you say, is behind the curve, then that would actually mean that towards the later half of the year, you could get some sort of a rate shock?
I don't know about the rate shock, but the interest rates are heading higher. And for, you know, if you mention that higher inflation will play itself out and is just a data, then everything else is a data too. So how can you isolate inflation data and say, oh, it's all right? We are more than 10% for the last month, and for April month, inflation was revised to 11% upwards. So it's a matter of great concern. So for anyone to shrug it off and saying, oh, we'll be fine, I disagree with that point completely, because now with the fuel price hike today, I think 10% odd number will remain for at least 5, 6, 7 months to come. And how on earth can we ignore this data? Because ground level reality is very different. I agree, money supply is coming in, Nifty is higher. So it tends to make people believe that if Nifty and Sensex are high, then everything's right with the economy. I mean, we may see the industrial production numbers being robust, but inflation is the key. And if it doesn't go down, which it will not till the end of the year, then RBI has no choice but to catch up. And we'll see the interest rate sensitives being effective, you know, the sectors.
Right. Is inflation necessarily bad for asset prices? You know, you're saying there's no rate shock. Rates, of course, higher rates are not good, but, you know, price inflation?
Well, not Sandeep, you want to weigh in on that one? Inflation can actually work out positive for certain segments of the market and certain sectors.
I mean, it's like being so bullish. I mean, when have we seen that 10% plus inflation is positive for any country?
Prashant needs to answer that one. That's his theory.
I'm not bullish. I'm not bearish. I'm just putting some questions to Sandeep there. You got a question here?
All right, he's done. Sandeep, I'm going to come back to the most serious point. I think the point that I was trying to make is on the interest rate side, yes, there may not be an interest rate shock, but then some of the sectors which are dependent on lower rates and have seen the upside, for instance, the consumer durables, one of the reasons that it picked up so dramatically was because rates were low, banks were lending easily. Autos perhaps is the other one. Do you then start to turn a little bit cautious on those, even though the consumer demand story is very much there, but the interest rate story could change things a little bit on that front?
Oh, absolutely. That's exactly what my point is. Once you see the interest rates inching up, the demand side of the equation changes dramatically, because the delta is very high from that perspective. You'll see auto sector's demand coming down quite a lot. That is the four-wheelers, commercial vehicles and passenger vehicles demand coming down, consumer durables coming down. So, you know, we have seen in the past that the Indian consumer is very, very sensitive to the interest rates. And if you take the cycle of the last 10 years, every time most of the boom in the interest rate is because the rates have been very low. And standing still, the corporate profits, because you know, corporate profits, even though a lot of QIPs have been done, the working capital requirements that have been tied up, if they start to move up, then you have a great impact on the corporate profits. So yes, I think that is a matter of concern.
But banks, though, Sandeep, banks would be able to bear this out in the case of banks. I mean, credit growth hasn't picked up yet, and if you say that it's going to be a bit of a lagging indicator, which some people say, second half of the year, positive for banks in India?
The credit growth can take care because of a lot of corporate demand, and you've seen the 3G side of it coming in and stepping in and filling the gap which the consumer credit was unable to do so. So I think consumer credit will remain at about between 10 to 15% levels. I'm not very bullish in terms of with interest rate rising scenario that the credit growth will pick up, but maybe from the corporate side. So, but the banking sector, we have been we have been positioned that we are long PSU banks with completely India centric portfolios with zero exposure to international markets, and we've been underweight the banks with international exposure, both private and PSUs. And we think that the Indian banking sector, looking inwards completely within the country, will stay very robust compared to banks having international exposures. Now, if there was a banking crisis, say in Greece, one of the banks blow up, you'll see the impact coming out to almost all the banks across the globe, because we don't really know where the risk lies, and it's like a domino effect. A bank going down in Greece, you can see that that's being affected. Like say an Australian bank can go down because of that. So I mean, you don't know exactly globally where the risk lies. So I think domestic banks are far better option than the banks with international exposure.
Okay, slightly on a lighter note, Sandeep, on the Greece front, but on a different note, I believe they're putting up some islands for sale. You're up for it? You're putting in bids?
I think there'll be a lot of land assets will be up for sale in Europe. It's just not Greece. You take a look at Spain, property prices are down 50–60%, and there are no bids in the market. So I think China is very gung-ho about that. I reckon China will end up buying half of Greece. So.
All right, okay.
China will buy half of Greece. Prashant Nair will buy the rest of it, is it? I mean, you've been watching property prices in Greece now.
Extremely unlikely. All right. Thanks so much, Sandeep, for taking out the time, joining us. Good chatting up with you as always.